Welcome to another edition of Wealthy and Wise. I'm your host, David Vanlandingham, and I'm here today with a very special guest, Mr. Adam Kintigh. For those of you that have been watching this channel for years and years, boy, he's a figure in your home, isn't he? Fantastic. We're going to be talking about solo Ks versus self-directed IRAs. We get a lot of questions about this. There are some differences based on what you're going to be doing. That's all part of why we do consultations. So, Adam, let's take that away. So what are some of the major things that we get asked about the differences between a solo K and a self-directed IRA?
Well, start with the kind of this, that having an IRA or a 401k. And the benefit of this is when you put money in, you get tax deferred or tax-free growth. And generally we got two types of IRAs, Roth and traditional. Two types of 401ks, Roth and traditional. So the money that you put into a traditional IRA or a traditional 401k grows tax deferred. Incredible benefit to having an account grow tax deferred. A Roth account, and by the way, when you put the money into a traditional IRA, you generally get a tax deduction. So if I put $7,000 into an IRA, I get a $7,000 tax deduction. If I'm putting money in through my employer, I get a tax deduction. It lowers my taxable income. The Roth account, we do not get the tax deduction, but eventually the money grows tax-free. So when I eventually pull the money out, there are no taxes on it. So given the option, we either take the tax benefit of getting a deduction now, and we pay taxes later, or we get the tax-free growth where I pull it out, I don't have to pay taxes on it. So I thought that was important just to kind of lay that groundwork before we get into the difference between the two.
So wait a minute, Adam, you're telling me if I took $8,000, because I'm in that upper category, and this would have been years ago, and I would have invested in NVIDIA through a Roth, I'd be rich, right?
You would be very rich.
None of that money, if I decide to take that money out at 59.5, I would presume, there's no taxes on any of it.
That's correct. And right now, when we do a self-directed account, so right now, typically if you're at Fidelity or one of these investment companies, you are limited to stocks, bonds, and mutual funds, versus if we self-direct account, then we're allowed to do things that are outside of stocks, bonds, and mutual funds. We can still do those things, but we could do things like buy real estate, invest in commercial syndications, invest in private equities or small businesses. So that's the beauty of a self-directed account. But you're right. If you had invested in NVIDIA, there's actually a few years ago, these guys invested in Bitcoin using their self-directed IRA. And it was a Roth IRA that he put, I don't know, $5,000, $10,000 in. And his account was worth over $1 billion. And because it was a Roth account, that was all tax-free money that he's able to pull out of it. So the Congress met and said, whoa, time out. We should probably stop the ability for these self-directed accounts, but that never passed, and you are allowed to do those things.
So that was $1 billion with a B, right?
B. With a
wow.
B.
So you can do cryptocurrencies, right, through self-directed retirement accounts then?
You sure can.
So it just kind of breaks the chains and gets you away from the typical stocks, bonds, mutual funds, and diversifies.
That's correct. And there was a video that I saw. It was the founder of Vanguard, Jack Bogle, and he had like a 60 minutes interview, and he said these 401ks and IRAs are the biggest racket ever. You put in all of the money, you bear all of the risk, and over a 50-year period with their modest 2% fees, they end up with fully 70% of your money. And that is the power and magic of tax, or the power and magic of compound fees. So when you start looking at doing things outside the stock market, your investment advisors don't like it much because they're not getting paid commissions, but it can really open the opportunities to a lot of investments that can really put you in a better position later on. Now, our legal disclaimer, David and I, we are not investment advisors. We don't tell you what to buy, when to buy, or where to buy, but we are experts in prohibited transactions and what you cannot do with that money. So I will say that.
Yeah, I mean, I'll go deeper. I'm not an attorney. I'm not a CPA. I'm not a I'm a big disappointment to my mother, but that's it. That's I got to live with that. But yeah, I mean, those are things that we have to consider, and then we do guide and direct clients based on what they're doing. So I think there's probably opportunities and times where one may favor the other. Which way to go? Do I go self-directed IRA? Do I go with the self-directed 401k. So in your take in dealing with our clients, in your consultations, what really points one way or the other, which one they should do?
Yeah. So if you have an IRA, so a few weeks ago, I talked to a lady that has $600,000 in a Roth IRA. And she wanted to use that $600,000 to go buy rental properties, and she was paying cash. We have one option, self-directed Roth IRA. However, and the reason for that is that if you have a traditional IRA or traditional 401k, 403b, 457, TIA CREF, TSP, certain annuities, those can be rolled into a solo 401k, where the solo K, we can put a lot more money into those accounts. And if you're a small business owner, you have a company that's wholly owned by you or you and your spouse, you maybe have one or two other partners in the business, you're allowed to do a self-directed 401k where the contribution limits are huge. Um, Traditional IRAs, you can put the $7,000 or $8,000 a year in, depending if you're over 50, under 50. The solo K, you can put between $69,000 to $76,000 that you can contribute. Massive advantages. So that's the number one difference is contribution limits.
Well, Adam, let me
Now,
jump in right quick because I know they did something special for me this year because they did something for the old guys. So they added you have the catch up contribution. So I think you're at 70,000 if you're 49 and under, 77,500 if you're 50 and above, and then they carved out a little niche for us old guys. 60 to 63, you got an additional 34.
4250.
Yeah, so it's $81,250 a year now. We can put away tax deferred. Beautiful.
Yeah, it's again with the solo 401k, or you could put so much more money in. And yeah, you're right. Old guys like you, we get that little bit extra. The extra, I think, is like 4250 extra per year that you can put in if you're in that sweet spot between 60 and 63. So contribution limits are higher. Secondly, is a lot of my clients are using their retirement accounts to invest in real estate. We've got this magic little bubble happening right now where a lot of real estate deals are coming on the market where you can pick up some great deals buying rental properties or apartment buildings or even commercial syndications. And what happens when you use an IRA and you make that investment, well, we have this option rather than paying cash for a property, we can leverage our funds. And there's banks out there that do what's called a non-recourse loan. So normally if I bought a rental property, I got to put 20% down, 30-year fixed rate mortgage. I'll buy the property, and over time, my renters will pay down that mortgage, and through inflation, the property value goes up and we build wealth. We can do the same thing with a self-directed IRA or a self-directed 401k. However, no personal guarantees involved. It has to be a non-recourse loan, meaning if you don't make the payment, the bank cannot come after you. They just get the property back. And because it's riskier for the bank, generally you got to put 50% down. Now, if I do that with an IRA, which nothing's stopping me, now I'm subject to a tax called a UDFI, unrelated debt financed income tax, which very quickly climbs to 37%. So any money that comes into my IRA as a result of those loans, I'm getting whacked with that tax. And I've got to file an extra tax return Form 990T to report that darn tax. The Solo K is exempt. It does not pay the UDFI tax. So I step back and look at when I'm talking with a client about which one's going to be better. Well, first thing is, do you have a business? Do you have a business of some kind? You could be a sole proprietorship. You could be an LLC that's disregarded. It could be an LLC taxed as an S Corp or a C Corp. Do you have a business that I can use as the sponsoring company of this solo 401k plan? If the answer is no, then we're probably going to do a self-directed IRA. However, if you have a business of some kind, then yes, I want to look at doing the solo 401k, which opens up all these great options, higher contribution limits, no UDFI tax, and the ability to borrow from your account. So right now, if you needed some cash for something, and again, we work with a lot of real estate investors. If I am doing a deal and I need some money for a down payment or covering a repair cost, if you pull money out of your IRA, you are subject to the taxes, state, federal, based on your tax bracket, plus the 10% penalty if you're under 59 and a half years old. However, if I rolled that money into a solo K, any of my old retirement accounts, I roll it to a solo K. Now we can borrow 50% of the value of the account up to $50,000 that you can borrow. If your spouse has one, she becomes a plan participant. The both of you can borrow $50,000 each. Now remember, you got to pay it back. It's amortized over 5 years. Instead of paying a bank interest or a credit card interest, you're paying yourself interest. You must charge yourself an interest rate of prime plus 1 or prime plus 2. So you'll be paying yourself roughly 8-9% interest on money that you're able to borrow. Again, cannot do that with an IRA. You can do that with a solo K.
That's amazing. So yeah, you often hear people wanting to tap into that money, and I guess there's different ways to look at it. You can borrow from it, from like one bucket, and then invest from the other. So lots of flexibility there. And when it comes down to the sponsor you were talking about, that's kind of like you go to work for IBM. IBM's a sponsor of your 401k, right? So they're just the ones that are making contributions and controlling the plan. So what I'm hearing is when you set up or you have your own business, that business becomes a sponsor. That's where the employer contributions come to as well, correct?
That's correct. So you, as an employee, you can put 100% of your salary up to what are the contribute? So last year it was
23,500. Yeah, 23,500 stayed the same, and I think for old guys went up to 31,000.
Okay, so you can put the extra. I guess it's 8,000 or 80 or 70. Well, 7,500 normally. This year they bumped that up, so it's 85. So you can put 100% of your salary up to 23,500 as an employee. If you're over 50, 100% of your salary up to 31,000 that you can contribute through your wages that you're taking out of your business. Your company can do a match equal to 25% of your salary. Did that change, David? Last year was 46.5.
It's 46.5 is the max. I think it's 25% of the business
Right.
gross, and then 46.5 is the dollar max.
Is the max. So yeah, so you can put these massive contributions. So I love this example. If you and your wife have a small business and you really want to max out your 401k plan, if you and your spouse, you're over 50, you each took a salary of $40,000, you can put in 30 grand, your spouse can put in 30 grand, your company can do a match equal to 25% of your salary. Well, that's another 10,000. So if your business made $100,000, each spouse taking $40,000, you could put fully $80,000 that you can contribute into the 401k plan. Absolutely awesome in terms of tax savings.
So in that case, so they're putting their ordinary or their reasonable salary, right? So they're putting Their contributions are coming from that. And then they still have the ownership distribution. So we're not just putting everything away where they don't have anything left over.
Yeah. So these are things where I always advise people, I don't know how this year is going to go. And it might be a good year. It might be a great year. I know it's going to be good at least. So usually we don't start making these contributions until we get to the end of the year. If you wanted to take out 10% of your paycheck and put it into the 401k plan, you sure can. But with most clients that I deal with, we're small businesses. We're going to wait usually October, November. Let's see how your company is done. And then we can decide how much money we want to put in. So your contributions as an employee, the contributions have to be made before December 31st. I have to document that on your payroll run before the end of this year, how much money you're putting in as an employee. The employer portion, your company match, does not have to be made until before we file the corporate return. So this is 2025. My corporate returns will be due March 15th of 2026. If I file an extension, I've got till September 15th of 2026. So plenty of time to decide how much my employer match is going to be. That employer match just has to be done before you file your business return for the 2025 tax season.
Yeah, I don't think people understand how important December is when it comes to these choices, right? Because when it comes to taxes, you got choices. Pay the tax, boo, right? Spend money or make contributions. That's really it. Those are the key three factors there that really determine, what you should be moving around. And it's a chess game, right? In December. So you need to get all these things done and done in a timely manner. So from what I'm hearing there's certain instances where the IRA is good. Sounds like the Solo K, if you have a business, is better because of more flexibility, borrowing from it, things like that, higher contribution. What would you say about between the two as far as administratively, how to control them, how to run them? Difficult. I mean, these are retirement accounts. You got to be responsible. Are there anything that we have to do on an annual basis for these?
That's a great question. So if you have a self-directed IRA, you have your custodian that is going to make sure that any of that stuff is taken care of. There is nothing to report unless you are leveraging funds. Like I say, if you're leveraging funds, then we have to do the Form 990T to report our UDFI tax and all that fun stuff. But with the Solo K, if your account is above $250,000 as the account value between cash and assets, you're above 250, we file Form 5500. It's just a very simple informational tax return that when you're above $250,000 for your 401k plan, you've got to file Form 5500. And normally, like our CPAs, we do that, or our custodians, we do that for our clients. But that would be the additional tax filing requirement, is if you have a Solo K, accounts above $250,000 in cash and assets, then we need to file Form 5500. So that's really it.
Okay, so that's just kind of like a statement of value of the account.
Yeah, and that's due by June 30th every year. So your personal return is due April 15th. Your business returns are due March 15th. And your informational return, Form 5500 for the IRS, those are due by June 30th.
That's incredible. Well, a lot of dates to remember, and I know that when we work with our clients, we make sure that they're up to date on all of those things and any changes that are being made. And right now, we're kind of in a world of change in a lot of different topics that we discuss on a weekly, monthly basis. So that's one of the things that we really do, Adam. I appreciate your expertise today. We always want people coming back. We want people to make sure that they like this video and they subscribe because the more they come back, the more wealthy and wise they'll be. Thank you.
Thanks for having me, David.
You bet.